Hello, everyone, and welcome to another Wall Street for Main Street podcast. Today we'll be featuring John Butler, author of The Golden Revolution. John, welcome to our podcast.
Thanks, John. Pleasure to be here.
All right, well, the first thing I want to get into was I actually read your book, The Golden Revolution. I liked it. I actually told you that before we got on the recording, but was the most interesting, I thought, was your background, that you worked in academia, you worked with Wall Street, and, Austrian economics. Can you tell our audience a little bit about your background?
Well, to elaborate on what you said, I did have an exposure to Austrian economic thinking when I was still quite young. I do have degrees in economics, finance, and also minors in history, politics. But I never particularly studied it directly when I was in school, but I had an exposure to it, and I also did an internship when I was quite young at the Cato Institute in Washington, D.C., which is the most sort of prominent Austrian-inspired think tank in the United States. So I had that exposure early on, and so when I went off to Wall Street into the lion's den, or however you want to call it, I was already equipped with an Austrian analytical toolkit, which I found extremely useful because, in fact, the history of Wall Street since I got there in the early 90s really has been a history of booms and busts, and Austrian business cycle theory is a very powerful way to understand what's been going on in recent decades. When you see the behavior of the Fed, when you see how easy money fuels bubbles, when you see how the busts are then addressed with even easier money and the subsequent bubble is even bigger than the one that came before, then you really see in practice, unfolding before your eyes, the insights of the Austrian school going back, originally to the 19th century, and then, of course, being developed much more thoroughly in the 20th. So having that academic background, having that early exposure to Austrian economics, and having that direct first-hand experience of finance in New York and also in Germany and the UK, where I work these days, has been, sort of a useful combination to at least I feel I have a perspective which is perhaps somewhat broader than most. It gives me the ability to see perhaps a slightly bigger picture than a lot of your typical, well, certainly most of your typical Wall Street analysts.
Yeah, I definitely agree. I think the Austrian business cycle explains a lot. We got the 87 stock market crash, which is followed up by a bigger tech bubble and then a bigger housing bubble. So, and Austrian economics has helped me understand it. Now, I'm not a quote-unquote expert, but I am familiar with it. But I want to get into your book because in your book, one of my favorite parts was the Bretton Woods system and how you talked about its failure and how West Germany was the first one to depeg. And I was just wondering if you could break down what our listeners would read about in your book about the Bretton Woods breaking down.
Well, Bretton Woods was a system which was not merely a gold-backed system, but it was also a dollar peg system, and it's important to look at both aspects of it. All currencies within the system, and that included all European currencies and all freely floating, I should say freely floating, but non-Soviet, non-communist Asian currencies. All of those currencies were part of the Bretton Woods system. They were all fixed to the dollar. Their exchange rates were all fixed to the dollar, and then the dollar itself was backed by gold at $35 per ounce. So there were sort of two sides to it. And it's important to distinguish between the two, because one problem that was occurring under Bretton Woods was that there was upward pressure on the gold price taking place. And this was because investors around the world sensed that at some future point in time, the United States might need to devalue the dollar versus gold. But there was also, on the other side, increased speculation that the dollar would not only perhaps devalue versus gold at some point, but that the dollar would devalue versus other currencies at some point. So there was also upward pressure on these other currencies. So West Germany, for example, which had a very, very strong economy in the 1960s, occasionally growing at nearly double-digit rates in some of those those years, very strongly growing economy, had tremendous upward pressure on the mark, and yet it had to maintain a stable rate versus the dollar. So naturally, West Germany was in the position of needing to sell marks into the market, that is, print more marks, print money, to prevent the mark from appreciating. But of course, those surplus marks, that liquidity, had to go somewhere. Well, and because marks were not themselves an international currency that could be used for international trade, they were used to buy up German assets. And of course, this leads to asset bubbles. And of course, this simply also started leading to consumer price inflation in Germany as well. And because the Bundesbank, the legendary West German central bank that was tasked with maintaining price stability, and the Bundesbank really found itself in a bind because it could perceive very directly the incompatibility of the Bretton Woods arrangements and its mandate to preserve price stability. And so while Germany was not as vocal as certain other countries, in particular France, with respect to the view that the Bretton Woods arrangements were no longer operating in their interests by the late 1960s, Germany may have stayed relatively quiet about it, but when push came to shove, in 1971, West Germany was the first of the Bretton Woods member countries to throw its hands up and say, enough is enough, we are going to allow the mark to float, which meant appreciate at that point, because the pressure on the mark was upward pressure. So they allowed the mark to float, and that was extraordinarily important with respect to the other side of the Bretton Woods peg, that between the dollar and gold. Because as soon as investors around the world perceived that West Germany was willing to break with Bretton Woods on the one side and allow the mark to appreciate, well then naturally even more investors piled into marks thinking, oh, this is great, this is our hedge against a weaker dollar. We don't need to buy gold. We can buy marks, which are themselves a fungible currency that can be used perhaps for purchasing German exports, whatever it is. And so it really kind of made a bad situation worse, and it led to a spiral effect of people selling dollars for marks and also accelerated selling of dollars for gold, and then Bretton Woods completely blew up. By August 1971, there was a run on the U.S. gold stock, and President Nixon was forced to suspend dollar convertibility from that point forward.
Yeah, definitely, and I still think the U.S. is suffering from the depeg of the gold standard, and it's generally accepted, at least in the Austrian school community, that Bretton Woods was a massive failure, but I actually still believe that even though Bretton Woods is quote-unquote officially dead, it's still unofficial policy with Asia. If you look at all the pegs to the dollar, especially China pegging their currency to the dollar, what do you see?
Well, certainly there are parallels, and there was a rather famous academic paper written in 2003 by some prominent economists arguing that the world was effectively operating on what they called a Bretton Woods II system. And if you look at the volume of U.S. trade around the world, an awful lot of trade between the United States and other countries takes place within very managed exchange rate regimes. China being the most obvious example, but it's not lost on observers of the foreign exchange markets that Brazil manages its currency rate vis-a-vis the dollar, India manages its currency rate vis-a-vis the dollar. China may be simply a bit more aggressive in that regard, but then even Japan, right? Even we regard Japan as a somewhat sort of capitalistic free market economy, and yet it's one that has been very active at managing the dollar-yen exchange rate for decades. So again, I think you're absolutely right. There is in effect a sort of de facto Bretton Woods type system in operation. We don't live in a world of free-floating currencies. We live in a world of managed currencies, which in some cases borders on nearly being pegged, such as China, for example. So that is the case, but as Austrian economics informs us, currency pegs are kind of like price fixing, and when you start fixing prices, you cause all sorts of market distortions in various ways. And when we see that in the way capital is flowing around the world. We see that in the way asset bubbles go from one place to another, or sometimes spontaneously. People scratch their head, why on earth is this particular stock market suddenly doing so well, or that particular property market suddenly doing so well? But when you're fixing prices around the world, and when the size of the flows is as large as they can be, given the excess liquidity in the global economy these days, naturally you're going to get all kinds of bubbles and distortions popping up all over the place. And it really demonstrates, the closer you look, the more you realize that policymakers may act like they're in control of all of this, but really they're not. And they're on extremely thin ice. There are all kinds of developments occurring around the edges of this Bretton Woods 2 system, which are really threatening the health of the financial system to this day. What happened in 2008 was not an isolated event. We're building up to something similar, although I can hardly predict exactly when and where it's going to begin to unfold.
Yeah, I definitely agree. And not only that, price controls. The most recent example is the 1970s, where they capped prices on gasoline prices, and of course that created fuel shortages. So price controls, they create more problems than they solve.
But just to jump in there, so many people who have firsthand memory of those long gasoline lines in the United States. The government actually said, as this was unfolding, the government came out and said this was literally because there simply wasn't enough gasoline to go around. There literally wasn't enough physical supply that was moving between the Middle East into the United States through the refineries and out to the gasoline stations. But that was complete BS, right? Everyone knows that it was as a result of the price fixing that you mentioned. They simply did not allow the price to rise to a level that made it economic for refiners to produce the amount of gasoline that motorists in fact demanded. So you had to wait in line instead. And it's a classic example of a price control causing a problem, a very evident problem to everyone who's waiting in line, wasting time trying to get gasoline, and yet policymakers completely denying their direct responsibility for creating that situation.
Yeah, I definitely agree. Not only that, policymakers, that's one thing they're good at, is denying it and then shifting blame to someone who shouldn't be blamed for it. Thomas Sowell, this is my favorite quote, is one of them. I have a lot of favorite quotes, but they solve one problem by creating three new ones.
Absolutely.
Yeah, and I actually wanted to get into this was, everyone says the general accepted theory is that the dollar is nothing but a fiat currency. It's a paper currency. I don't know what to call it. Maybe an elastic currency. I actually don't think it's a pure paper currency. I actually think it's back. They call it the petrodollar. And people who say the U.S. is a petrodollar and a paper currency, that doesn't make sense to me, because I think the U.S. dollar, besides toxic assets, it's also backed by the fact that you can buy oil from anywhere in the world. That will change, but for now. So I'd call it something different, an elastic currency. What are your thoughts? Would you say it's pure paper, or?
Well, I mean, the definition of a fiat currency is it's simply a currency which is created by government edict. It's not a currency that arises spontaneously out of the market, and it's a currency that would not be used at all if a government did not create it to specifically serve as a currency in the first place. And that's what differentiates a fiat currency from, say, gold and silver, which can function as money with or without government sanction. And in fact, they probably would function as money in certain respects today, were they not effectively illegal because they're not themselves legal tender. But going back to your point, I think your observation is an important one. I think in a strict definition of what a fiat currency is, I think the dollar more or less meets that definition, but that does not mean, as you say, that the dollar is not, however, is unique perhaps among fiat currencies, in that it does have this additional sort of credibility and backing which is implied by the global oil trade. Now, you may be under no obligation to save in dollars, but as you point out, the pricing convention globally for transacting in oil is in dollars, and so you'll have to go into the market to acquire dollars if you want to buy oil in size internationally. That's simply the way the system works. And so you could say that there is at a minimum a certain level of implied transactional demand for dollars that is going to exist regardless of whether the dollar is in demand as a store of value. And so, yes, that's an aspect of the dollar which I think certainly does make it unique amongst fiat currencies and gives it this quality which a truly purely fiat currency that wasn't required for any particular use would have. So I take your point on that. But let's keep in mind how fragile this situation could be as well. Now, who's to say that the global oil trade will remain a dollar-based transactional trade forever? I mean, it could be that multiple oil producers get more flexible with respect to their pricing conventions. It could be that some of the biggest consumers of oil in the world, such as China and India, decide that they, in fact, would prefer to use their own currencies. Might shake your head at that and say, "Oh, come on, they wouldn't start trading oil for not convertible currency such as the yuan or one that's managed as heavily as the rupiah." I mean, come on, is that realistic? Well, maybe it is realistic. And in fact, if you look at what Brazil, Russia, India, and China talk about when they get together for their annual summits of the BRIC countries, they talk about things like creating a single currency for themselves, working together with the oil producers to explore options for what they could do in the future. I think if they're saying these sorts of things in public, imagine what they're discussing in private. I would be very surprised, in fact, if there were not active discussions taking place behind the scenes between the BRIC countries, between the oil producers, about how possibly they might wean themselves off the dollar at some point in time. I argue in my book I think it's going on, and in fact I give some specific examples for things that could happen in future if this continues to develop in this way.
Yeah, I definitely agree. That's why I said that will change, or it could change. Not only that, what's very underreported in the U.S. media. Well, it's not really reported. I found it alternative media. But right now, China, they're running a naval test for Saudi Arabia. And the word is once China proves it can protect the supply lines for Saudi Arabia and other OPECs, they'll start transacting in other currencies. And not only that, China and Saudi Arabia are actually building the world's largest refinery. So I do think, within this decade, this is just my opinion, that they see the Federal Reserve keep devaluing their dollars. And I read in another book, Vega Volatility, Saudi Arabia lost a lot of money to this housing bubble because in their sovereign wealth fund, they're heavily invested in the U.S. housing market. So, they're not going to take those losses lightly. So I do see the OPEC countries, especially the Mideast, willing to transact out of dollars. And I've read that Iran, the reason that, this sort of trade war with Iran's going on is they wanted gold. And I've also read Libya wanted to transact in gold. So I do think it will change. And you did read in the book, it was how am I right on this, that the BRICS collectively, from what I got, was individually they couldn't challenge the U.S., but as a whole they would. And they would prefer to transact in something else. And they believe collectively they could get off the U.S. reserve system. What are your thoughts?
Well, I think it's certainly easier if they work together. And if you look at how they're thinking in their official statements, there's a lot of evidence that they see tremendous value in working together towards creating some new global currency regime which is more in line with their national interests. And so they clearly appear to have identified the dollar as a problem. And the what I call the fiat dollar reserve standard, again, I understand that, as you point out, the dollar is a unique currency in many ways, but I call the current global system the fiat dollar reserve standard. The BRICS perceive this is not in their interest, so they're trying to find a way around it. And they're talking to, as you point out, among others, the oil-producing countries to try and see what arrangements they might be able to get to in future. The fact is that if any one of the BRIC countries tried, say, unilaterally to displace the dollar, it would be an extremely difficult thing to do. I mean, how does any one of those countries make their currency materially more attractive than the dollar? Well, I do speculate in my book, and I'm not the only one has speculated in this sort of direction, that one thing you could do is back your currency with gold. I mean, if you wanted to make your currency more desirable, peg it to gold, and people will see it as a more stable store of value, and therefore they'll perhaps begin also using it for transactions around the world if it's accepted, which if it's gold-backed, it probably would be. But if only one of them does it on their own, and as a result of demand for their gold-backed currency, it becomes very, very strong, well, then they're going to have a problem with respect to their trade situation, and they might find that their exports are collapsing and this sort of thing. But it's notable that the BRIC countries as a group, they trade more with each other than they trade with the United States. And if they all were to move towards some sort of currency basket where they peg their currencies to each other and possibly they all back their currencies with gold, well, then if that implied that their currencies would strengthen, if they strengthened vis-a-vis each other, it would have far less of an impact on their net trade balances. It would be far less disruptive for their economies. But what they would find is that collectively they probably would be able to displace the dollar as the world's preferred not just reserve currency, but transactional currency for things like oil, and that would be a stabilizing influence on their economies. And, of course, it would get them around this problem that it's the Federal Reserve that creates the dollars. It's the United States that owns the printing press and that receives the maximum benefit from the new dollars that are created as it tries to bail out its financial system, the legacy of the housing bubble, and all of these things. I mean, it's not lost on the BRICS that they're kind of the big losers in all this. They accumulate these paper dollars, which they know are being devalued and are probably going to continue being devalued in future, but they don't know what else to do because that's just the way the global financial system currently works. And if you want to grow and grow your exports, you've got to accept these dollars. They'd really prefer not to. They really would prefer to find a way out of this dilemma. And I do offer up in my book sort of a detailed way in which I think that could come about, and I think it's becoming increasingly plausible. The BRICS meet every spring for a summit. Last year, they announced they were studying the creation of their own World Bank and IMF as a replacement for these Western monetary institutions that they don't necessarily trust anymore. Well, they're going to report on that plan at their upcoming summit this spring, and it could be that, in fact, they're going to go ahead with it. Maybe they really will take some truly remarkable historic steps towards moving away from using the dollar and towards using their own currencies instead, and we'll see what the world thinks of that. I think the world will respond to it with some very, very interesting policy shifts and perhaps a significant decline in use of the dollar around the world.
I definitely think the future looks interesting. I would say this is a definite, I would say definitely a great part in your book, and it was about the gold standard, and there are a lot of sentiment that if we go back to the gold standard, a lot of problems would be fixed. But you actually warn about the dangers of going back to the gold standard. Not that the gold standard is going back in a wrong way, but you warn about if you don't implement it properly, it can cause more problems than you already have. Can you go over that part of your book?
Well, now my book makes the case, which I know is quite provocative, but it does make the case that I believe that a return to using gold or gold-backed currency for international trade is probably inevitable, and I make that case at length in the first part of my book. But what I mean by that is for international trade. I don't mean internally for domestic purposes. I don't mean to suggest in my book that we're suddenly going to be using gold and silver coins as we go down the road to the shops. While don't get me wrong, I'm not casting judgment on it one way or the other here. In fact, I think it would be a fine system in principle. But the point of my book is that a return to some form of gold-backed currency, use of gold in international trade specifically, is inevitable. But the problem is this: is that let's say that you are an importing nation like the United States, and the world moves back towards using gold-backed currency for international trade. Well, if you're an importing country and your currency is pegged at a level which makes it just prohibitively expensive for you to import what you need, you're going to have you're going to have a big inflation problem. And on the other side of that, if your currency is one that is if you're a big exporter, and you find that your currency is pegged at a rate which leaves it too strong, then you'll find you're not able to export competitively anymore. And this is going to be hugely disruptive. Now, I mean, economies can always adjust. Economies, if left alone to their own devices, let the free market work its magic, prices will adjust, and eventually imbalances will get sorted out. But what you don't want to do, if you're moving back towards gold, you don't want to do it in a way that creates even more problems than you've already got. You want to do it in a way which is the least disruptive way possible. And so I offer up in my book the recommendation specifically of Henry Hazlitt, who was a very prominent economics commentator in the United States in the 1950s and 1960s. And he said, look, if you want to go back to using a gold-backed currency, the best way to do it is to announce your intentions to the market, to allow the free market, a free unregulated market, to move relative prices in the interim. So you actually give the markets the hint. You don't suddenly say, oh, by the way, we're going back to gold tomorrow. You give the markets time to adjust. You give them a due date. You say by this date or henceforth from that date, 6 months down the road, 1 year down the road, 2 years down the road, whatever it is, from that point forward, we will take whatever relative price levels adjustments have taken place, and we will henceforth be fixing to gold at that rate. And so you allow the adjustments to take place naturally through the free market in the interim, so that when you do begin using gold, you will not thereafter have to endure very volatile, disruptive swings in relative prices, and that will prevent people blaming the move to gold as the cause of those sorts of problems, because that will already have been taken care of. It will already have been done before you go back on gold. And this is the big mistake that Winston Churchill made in Great Britain. He was Chancellor of the Exchequer in the early 1920s, and the gold standard had been suspended in Britain to create inflation to finance World War I. But once World War I ended, it was overwhelmingly the popular political choice in Britain to re-implement the gold standard, which was associated with such rapid rates of economic growth and also low and stable prices. So the pressure was on Churchill to get this done, and he felt the easiest way to get Britain back onto the gold standard was to go back onto the gold standard at the previous parity rate prior to World War I, prior to this great inflation that was required to pay for World War I. But what that did, because he went back on that previous parity rate, it caused a huge decline in the price level. It forced huge declines in wages through the system, and workers felt they were being, workers felt their purchasing power was being devalued, their wages were being devalued. So you had all these strikes, and the strikes led to major industrial unrest, and that led to a negative economic spiral because industrial production was collapsing, meaning the supply of goods was collapsing. That was placing upward pressure on prices. At the same time, there was downward pressure on wages because of the monetary deflation taking place, and basically it caused a severe recession. And it was blamed, however, on going back on the gold standard, and that was wrong, that was unfair. Had Churchill simply accepted in 1925 that there had been lots of inflation, that going back on gold was not a bad idea in principle, it was a good idea in principle, but had he simply gone back onto gold at the prevailing price level and not forced this severe deflation through the system, then you wouldn't have had to go through those adjustments. You would simply have started over at this new price level, accepting that inflation was necessary to pay for the war, but that was over now, so let's just move on. It could have been done that way. No one would have blamed gold for a recession because there wouldn't have been a recession. Britain would have ended up back on the gold standard, wouldn't have gone through industrial unrest and strikes, would have remained a more productive economy, and by extension, the economic mayhem that escalated into the late 1920s, early 1930s, and of course we call it today the Great Depression, it would never have happened. And it's really a great tragedy, one that Churchill himself deserves quite a bit of historical blame for, but historians don't tend to go at him for this decision, although I do in my book.
All right. And my last question will be, is a lot of people say that eventually gold will be in a bubble, but your book makes a compelling argument, which I actually do agree that it will be the standard of international trade. People say, when's it going to happen? I just say, I'm not a timer, but it will happen when it happens, but it will happen. But do you think gold could be in a bubble while also being the standard for international trade?
An actual sort of time horizon prediction, or?
No, not a prediction, but do you think it's possible that while gold, like when this gold revolution happens and becomes the standard of trade, do you think a bubble could soon follow, or possibility, not like predictions?
Well, I mean, if you think about it, money itself, in a way, can become a bubble. If you hoard more cash in savings, and don't invest it productively, if society in general is stuffing money in the mattress, if people are unwilling to grant each other credit for new investment, all of these things are potentially very negative. And in a way, we normally think of bubbles being asset bubbles, for example. But money itself, fine. If no one's willing to hold assets, if everyone's frightened to hold assets, and everyone just flees into risk-free or essentially risk-free money, I guess in a way you could say that money itself becomes a bubble. But the way you think about it is very different. Money itself is a bubble because of fear. People are frightened to move into other assets, so they all pile into money. They refuse to invest. They refuse to extend credit, and that can be very, very damaging to an economy. And in fact, in very severe circumstances, if you're not even willing to deploy enough of your money to maintain the existing capital stock, then you're going to be consuming your capital stock, which will permanently reduce your standard of living. So, looked at it in that way, I guess you could say that anything that's being used as money could find itself as a bubble of sorts, which could cause tremendous economic damage in the way I've just described. Could that happen to gold? Well, if gold is remonetized, then yes, you could have a situation where you could argue that people around the world are just too frightened to invest, too frightened to trade with each other, and so they all seek to hoard their gold and drive the price of gold up to the moon. But by doing so, it implies they're not trading with each other as much as they otherwise would, not investing as much as they otherwise would, and that would certainly be to the detriment of the global economy. Is it possible that will happen? Sure, it's possible that would happen. That said, I have tremendous faith in the free market to sort it out. And the thing about this sort of bubble that I'm describing here, which is kind of a fear-driven bubble, you have to ask yourself, step back, what would be causing the fear? Would the fear be caused by policymakers doing sensible things, or would the fear be caused by policymakers doing not sensible things? I mean, obviously, in my view, if the policymakers are perceived to be following sensible, sustainable policies and more or less staying out of the way and letting the free market work its magic, then I think it's highly, highly unlikely that everybody would simply flee into money, flee into gold, be unwilling to trade, be unwilling to invest. So really, what we have to look at is what causes that sort of fear, what could cause that sort of bubble in money, bubble in gold. But unfortunately, you look around the world today, and we see policymakers mucking around with the marketplace just about everywhere. We've talked about the price fixing of currencies, but of course, we know interest rates are fixed by central banks. We know they're doing this to target asset prices, which are becoming bubbles in their own right, left, right, and center. It's a world in which there's tremendous reason to be very, very concerned about the future. This probably is doing tremendous damage to healthy rates of investment. It probably is resulting in depreciation of the capital stock. It probably is going to have a very prolonged negative impact on economic growth and our standard of living. So we need to get away from that. We need to restore confidence. And how do you restore confidence in money? Well, in my book, I argue ultimately you've got to back it with something, and gold is just the most obvious candidate in that regard.
Yes, I definitely agree there, and I just want to say, personally, after I read your book, when I was talking to my colleague Jason, he asked me about it, and I said, the first thing I said was, you can tell he's a very, very smart guy, and that was my expectations coming in, and you've exceeded them during this interview.
Oh, thank you, John.
It was a pleasure interviewing you, and if our audience wants to find out more about you, where can they go?
Well, I do maintain a website which is named after my company. It's www.amphora-alpha.com. Amphora is, for those of you who know, it's a form of ancient Mediterranean pottery, and it's a metaphor for a store of value, because people used to store valuable things in these amphorae, be it fresh water, wine, olive oil, nuts, seeds, grains, whatever it might be. So Amphora is my company, and amphora-alpha.com is my website.
All right.